What is your takeaway from how investors are evaluating these results?
Well, I think it's certainly a tough market out there, as you acknowledge. But at the same time, at DoorDash, we're focused on the fundamentals, and the fundamentals for DoorDash are incredibly strong. As you saw, with this most recent quarter, we announced all-time highs in our monthly active users, our Dash Pass subscribers, as well as order frequency across cohorts. We're continuing to build into new categories beyond restaurants, into grocery, convenience, retail. We're launching more than just the United States as a global business, and we're also making tremendous progress on building our platform, in which we're helping physical businesses become digital powerhouses, in addition to the local marketplace that we've been building. So in times like these, especially, what I tell our teams is to focus on, the fundamentals and keep building the business.
Investors seem to really be punishing, or at least questioning, growth stocks. And I know some are wondering, oh, was it because of Omicron that DoorDash saw this boost in the last quarter? Is that going to keep up quarter after quarter after quarter? How do you respond to that?
Well, it's been 2 years now, or maybe a little over that, during the pandemic season, and we've continued to see growth. I mean, our U.S. restaurants business has grown 250% over the last couple of years. We've gained 14 points of absolute share in the category. And I think what you've seen, whether it was early on in the pandemic, as certain states opened up maybe a little bit ahead of others, or now where everyone thankfully are finally getting back into their normal lives of seeing their friends and family in person, it's that people, even though they eat out and celebrate, they're continuing to order delivery. I mean, that's why you're seeing, the all-time highs that we've seen in the business. In addition to that, we've also increased our profitability on top of an already profitable business altogether. And so, we've seen a lot of strength in the business, both in terms of the demand, but also in terms of our bottom line.
Consumers are under pressure, though. Inflation is rising. Gas prices are rising. These are factors beyond your control. How are you thinking about the macroeconomic environment ahead? I mean, are you just kind of preparing for more uncertainty?
Well, we've been studying inflation pretty carefully now for the past 4 to 6 quarters, because I think it happened actually, or the growth of inflation, I should say, occurred maybe a bit more sharply than some had anticipated. And it continues to be a real concern. So for us, the focus is on taking care of all the audiences. Obviously, we can't control the rate of change of inflation, but we can control what we do for Dashers, making sure that we're giving 10% cash back on fuel expenses, making sure that we are paying bonuses for longer distances driven, making sure that we're working with merchants to find even new ways to grow as they're dealing with both labor shortages as well as inflationary pressures. And we can do that because we have a robust restaurants business where consumer demand is still very resilient, which gives us the ability to reinvest those profits into absorbing any costs from inflation so that consumers don't have to bear any of that burden.
We did see a number of analysts cut price targets on DoorDash this morning, and I wonder how tight the labor market is for you in particular. I mean, because it's not just restaurants that need labor, it's DoorDash and Uber and Lyft and Domino's Pizza that are fighting for drivers.
Well, we haven't actually seen any challenges in getting drivers on the road. In fact, even before the recent rises in fuel expenses, or the sharp uptick, I should say, in fuel expenses, we had plenty of drivers on the road. And that's because structurally, we have a pool of drivers that is just much larger than other services like ride sharing. 90% of the Dashers on DoorDash, of the 3 million plus that come to our platform and does deliveries on a quarterly basis, 90% of them deliver fewer than 10 hours a week. The average Dasher only completes about 4 hours of work every week. And so when you think about it from that context, where it's truly part-time and supplemental income, and you compare it to something like ride sharing, which is more full-time, it's just orders of magnitude larger in terms of the base of drivers we can address. And for those reasons, we actually haven't seen any of those pressures of getting drivers on the road. But that said, we do recognize that inflation is very real, and that's why we decided to invest in those Dasher programs to make sure that their earnings would not be impacted.
Interesting. Well, on one hand, you're hearing Lyft say they're going to have to invest significantly to incentivize drivers. Uber saying they don't have to, but they are making some changes to the app, more transparency to keep those drivers coming back. And I wonder, Are you going to prioritize the courier app experience, and how, if your competitors are trying to step up those levers?
Well, we don't really compete against ride sharing for drivers. I mean, 96% of drivers that we've surveyed, on the DoorDash platform have no interest in, driving other people. They just prefer to do deliveries. I mean, if you think about it, I mean, the two user bases couldn't be, further apart in terms of how they self-select which platforms to work on.
But what about Uber Eats? What about Instacart?
Yeah,
what about, Domino's?
Sure. I mean, as the largest platform in the U.S. that provides more work opportunities on a daily basis across more geographies, we're just the first consideration for most of these workers. I mean, we're always going to, your question about investing in the Dasher app, of course, we're always investing, behind that experience to make sure that it's lower friction to earn whenever you want, wherever you want, and to do it, with consistent expectations of what you will earn when you are on the road because the work is so part-time.
Investors are also suggesting we're going to see a lot more consolidation in this space. And given that DoorDash is the big player in this market, that makes you potentially a prime acquirer. We saw you buy Volt, for example. Are we going to see you do more deals? Are you looking for more deals? And if so, in what areas?
Well, the bar for M&A is very high for us at DoorDash. And that's because we really respect how difficult it is to actually do it really well. So for us, two things have to be true. Number one, it certainly has to be accretive to the business. Number two, it also has to be accretive to the management bandwidth that we have at DoorDash. I mean, we're trying to build the largest local commerce business globally. So we have a lot of work on our plate. So we have to make sure that there can't be any distractions, that it's entirely focused. That's why, Volt was such a perfect example. Volt certainly adds to our international global footprint, doubling almost our addressable market. But the way in which they build their business, the culture around building the best product, making sure that they do it in a capital efficient way, that aligns very well with how we do things at DoorDash. And that was a perfect example of when M&A made sense.